Question 1. An insured purchased a life insurance policy and named his wife as the sole beneficiary. 8 years later, the insured died by suicide. Which of the following statements is true regarding the policy's payout? A. The policy will pay the full death benefit because the suicide occurred outside the exclusion period. B. The policy will pay the cash value only, as suicide is always excluded. C. The policy will pay the premiums paid plus interest, but not the death benefit. D. The policy will be voided, and no payout will be made due to the circumstances of death. Answer: A. The policy will pay the full death benefit because the suicide occurred outside the exclusion period. Life insurance policies typically include a suicide clause, which states that if the insured commits suicide within a specified period, usually 2 years, from the policy's issue date, the insurer's liability is limited to a refund of premiums paid. Since the suicide occurred 8 years after the policy was purchased, it falls outside this exclusion period, meaning the full death benefit would be paid to the beneficiary. This clause is in place to prevent individuals from purchasing a policy with the intent of committing suicide, but after the exclusionary period, the policy is treated like any other death claim. Always check the policy's suicide clause period, as it is a critical detail. Question 2. Which type of health insurance policy would most likely require an insured to select a primary care physician, PCP, and obtain a referral to see a specialist? A. Preferred Provider Organization, PPO. B. Exclusive Provider Organization, EPO. C. Health Maintenance Organization, HMO. D. Indemnity Plan. Answer: C. Health Maintenance Organization, HMO. Health maintenance organizations, HMOs, are known for their strict managed care approach, which typically requires members to choose a primary care physician, PCP, within the HMO's network. This PCP acts as a gatekeeper and must provide a referral for the insured to see any specialist, ensuring coordinated care and cost control. In contrast, PPOs offer more flexibility, allowing direct access to specialists, while EPOs are a hybrid that may or may not require referrals depending on the specific plan but still restrict providers to a network. Remember that the H in HMO stands for health, but also think of hub as in the PCP being the central hub for care. Question 3. A policy owner has a universal life insurance policy. Which of the following accurately describes a unique characteristic of this policy type compared to whole life? A. Universal life offers fixed premiums and a guaranteed interest rate on its cash value. B. Universal life allows for flexible premiums and adjustable death benefits. C. Universal life has a fixed death benefit and non-forfeiture options only at surrender. D. Universal life guarantees level premiums for the life of the policy, similar to term life. Answer: B. Universal life allows for flexible premiums and adjustable death benefits. Universal life insurance policies are distinctive because they offer significant flexibility in both premium payments and death benefits, which can be adjusted by the policy owner within certain limits. Unlike traditional whole life policies that have fixed premiums and a level death benefit, universal life allows the policy owner to vary the amount and timing of premium payments and even increase or decrease the death benefit, subject to underwriting and minimum policy values. This flexibility makes universal life appealing to individuals whose financial needs or ability to pay premiums may change over time. Think of universal life as having universal flexibility for premiums and death benefits. Question 4. Which of the following statements is true regarding policy loans from a life insurance policy's cash value? A. Policy loans are generally considered taxable income to the policyholder. B. Policy loans reduce the death benefit payable if not repaid before the insured's death. C. Policy loans must be repaid with interest within a specified period to avoid policy lapse. D. Policy loans are subject to capital gains tax upon withdrawal, similar to a surrender. Answer: B. Policy loans reduce the death benefit payable if not repaid before the insured's death. When a policyholder takes a loan against the cash value of their life insurance policy, the outstanding loan balance, including any accrued interest, will be deducted from the death benefit paid out to the beneficiary if the insured dies before the loan is fully repaid. Policy loans are generally not considered taxable income because they are technically a withdrawal against the policy's cash value, not a distribution of earnings, and there is no strict repayment schedule unless the policy is surrendered. Think of a policy loan as borrowing against your own future death benefit. Question 5. Under COBRA, a qualified beneficiary, typically an employee, can continue group health coverage for a maximum of 18 months for which of the following qualifying events? A. Death of the covered employee. B. Divorce or legal separation from the covered employee. C. Reduction in hours of employment or termination of employment for reasons other than gross misconduct. D. Medicare entitlement of the covered employee. Answer: C. Reduction in hours of employment or termination of employment for reasons other than gross misconduct. COBRA, Consolidated Omnibus Budget Reconciliation Act, allows eligible employees and their dependents to temporarily continue health coverage under specific, qualifying events. A reduction in hours of employment or voluntary/involuntary termination, not due to gross misconduct, are common qualifying events that typically allow the employee to continue coverage for up to 18 months. Other events like death, divorce, or Medicare entitlement usually apply to dependents and may allow for longer continuation periods, e.g., 36 months. Remember that COBRA is about continuation, not free coverage, and the employee must pay the full premium plus an administrative fee. Question 6. A life insurance policy that features a cash value that fluctuates based on the performance of a separate account, and requires the agent to hold both a life insurance license and a securities license, is known as A. Whole life policy. B. Universal life policy. C. Variable life policy. D. Indexed universal life policy. Answer: C. Variable life policy. A variable life insurance policy is unique because its cash value and death benefit are directly tied to the performance of underlying investment subaccounts chosen by the policy owner, which are held in a separate account. Because these subaccounts are considered securities, an agent must possess both a state life insurance license and a FINRA, Financial Industry Regulatory Authority, securities license to sell variable life products. This dual licensing requirement highlights the investment risk associated with these policies, differentiating them from traditional fixed-value life insurance. Think of variable as meaning variable performance based on investments, hence the securities license. Question 7. An annuitant chooses a life with 10-year period certain payout option. If the annuitant dies after 7 years, what will happen to the remaining payments? A. All payments cease immediately. B. Payments will continue to a designated beneficiary for 3 more years. C. Payments will continue to the annuitant's estate indefinitely. D. The lump sum value of remaining payments will be paid to the annuitant's spouse. Answer: B. Payments will continue to a designated beneficiary for 3 more years. The life with period certain annuity payout option guarantees income payments for the annuitant's lifetime, but also for a minimum specified period, that is certain period, even if the annuitant dies before that period is over. In this case, with a 10-year period certain, if the annuitant dies after 7 years, the remaining 3 years of guaranteed payments, 10 minus 7 is equal to 3, will be paid to their designated beneficiary. This option provides a balance between lifetime income and protection for beneficiaries. Remember, period certain guarantees payments for that minimum duration. Question 8. An individual turning 65 years old and already receiving Social Security retirement benefits will be automatically enrolled in which parts of Medicare? A. Part A and Part B. B. Part A only. C. Part B only. D. Part A, Part B, and Part D. Answer: A. Part A and Part B. Individuals who are already receiving Social Security retirement benefits at least 4 months before their 65th birthday are automatically enrolled in both Medicare Part A, hospital insurance, which is typically premium-free, and Medicare Part B, medical insurance, which requires a monthly premium. If the individual chooses not to have Part B, they must decline it during this initial enrollment. Understanding this automatic enrollment helps explain why many seniors have both parts without needing to manually sign up. Question 9. In contrast to individual life insurance, group life insurance policies typically: A. Require individual underwriting for each certificate holder. B. Offer higher face amounts at lower premium rates due to adverse selection. C. Are issued without requiring evidence of insurability from individual members. D. Are convertible to an individual policy at any time without premium adjustment. Answer: C. Are issued without requiring evidence of insurability from individual members. Group life insurance policies are a key example of how risk is spread and managed differently than in individual policies. Typically, individuals within a group, e.g., employees of a company, are covered without needing to provide evidence of insurability, like a medical exam or health questionnaire, primarily because the group itself provides a broad risk pool. This lack of individual underwriting helps prevent adverse selection and makes coverage accessible, as long as the group meets certain eligibility criteria. Think of group coverage as a blanket policy for many, rather than tailored for one. Question 10. For long-term care insurance policies, which of the following is most commonly used as a trigger for benefits to begin? A. An insured's age reaching 70. B. The diagnosis of a severe chronic illness, regardless of functional ability. C. The inability to perform a specified number of activities of daily living, ADLs, or cognitive impairment. D. A physician's recommendation for skilled nursing care, even if not medically necessary. Answer: C. The inability to perform a specified number of activities of daily living, ADLs, or cognitive impairment. Long-term care insurance policies are designed to cover the costs of assistance with daily living, and benefits are most commonly triggered when an insured cannot perform a certain number, usually 2 or more, of the activities of daily living, ADLs, without substantial assistance, or if they suffer from severe cognitive impairment. ADLs typically include bathing, dressing, eating, continence, toileting, and transferring. This functional trigger ensures that benefits are paid based on a genuine need for care, rather than just an age or medical diagnosis alone. Understanding ADLs is crucial for knowing when an LTC policy will pay. Question 11. To reinstate a lapsed life insurance policy, an insured typically must satisfy all of the following conditions except: A. Provide evidence of insurability. B. Pay all overdue premiums with interest. C. Repay any outstanding policy loans with interest. D. Wait a new contestable period to begin. Answer: D. Wait a new contestable period to begin. When a life insurance policy is reinstated, the original incontestability period does not typically restart, it continues from the policy's original issue date, although some states may have a limited new contestable period for the reinstatement itself. To reinstate, an insured must generally provide evidence of continued insurability, pay back all overdue premiums with interest, and sometimes repay any outstanding policy loans with interest. The purpose of reinstatement is to restore the original policy, not to issue a new one, which is why a full new contestable period does not usually begin. Question 12. Which type of business health insurance provides coverage for ongoing business expenses, such as rent and utilities, if the business owner becomes disabled? A. Key person disability insurance. B. Disability buy-sell insurance. C. Business overhead expense, BOE, insurance. D. Group disability income insurance. Answer: C. Business overhead expense, BOE, insurance. Business overhead expense, BOE, insurance is specifically designed to cover the fixed, ongoing operating expenses of a business if the owner or a key professional becomes totally disabled. This type of policy helps ensure the business can continue to operate by paying for things like rent, utilities, employee salaries, and other recurring costs. It is distinct from key person disability, which covers the financial loss to the business from the disability of a crucial employee, or disability buy-sell, which funds a buyout of a disabled owner's interest. BOE keeps the lights on when the owner cannot. Question 13. An accelerated, living, benefits rider in a life insurance policy allows the policy owner to A. Borrow against the policy's cash value at a reduced interest rate. B. Receive a portion of the death benefit early if diagnosed with a terminal or specified critical illness. C. Increase the death benefit without providing evidence of insurability. D. Convert the policy into an annuity during the insured's lifetime. Answer: B. Receive a portion of the death benefit early if diagnosed with a terminal or specified critical illness. An accelerated, living, benefits rider is an endorsement on a life insurance policy that allows the policy owner to access a portion of the policy's death benefit while the insured is still alive. This is typically triggered by qualifying events such as a terminal illness with a limited life expectancy, a critical illness, like cancer or heart attack, or confinement to a long-term care facility. This feature provides much-needed funds during a difficult time, with the remaining death benefit paid to the beneficiary upon the insured's death. Think of it as accelerating the death benefit payment to help with living expenses. Question 14. An insurance contract is considered an aleatory contract because A. It is prepared by one party, the insurer, and accepted or rejected by the other party, the insured, without negotiation. B. It represents the utmost good faith between both parties involved in the contract. C. The values exchanged by the parties are unequal and dependent on an uncertain event. D. Only one party, the insurer, makes an enforceable promise. Answer: C. The values exchanged by the parties are unequal and dependent on an uncertain event. An insurance contract is considered aleatory because the exchange of values between the insurer and the insured is unequal and contingent upon the occurrence of an uncertain future event. The insured pays a relatively small premium, but the insurer promises to pay a much larger sum, the death benefit or claim, if a covered event occurs. If the event never happens, the insurer pays nothing. This characteristic highlights the element of chance in insurance contracts. Remember that aleatory relates to chance or uncertainty, similar to a gamble. Question 15. Which of the following Medicare supplement, Medigap, plans offers the most comprehensive benefits, typically covering all of Medicare's gaps including Part B excess charges? A. Plan A. B. Plan B. C. Plan F. D. Plan G. Answer: C. Plan F. Medicare Supplement, or Medigap, plans are standardized plans that help fill the gaps in Original Medicare, Parts A and B. Among the available plans, Plan F historically offered the most comprehensive coverage, paying for all of Medicare's deductibles, copayments, coinsurance, and Part B excess charges. However, Plan F is only available to those eligible for Medicare before January 1, 2020. For those newly eligible after this date, Plan G is the most comprehensive option available, as it covers everything Plan F does except the Part B deductible. Question 16. The free look provision in a life insurance policy gives the policy owner the right to A. Change beneficiaries without the insurer's approval. B. Examine the policy for a specific number of days and return it for a full refund of premiums if not satisfied. C. Receive a partial refund of premiums if they cancel the policy after the first year. D. Access the policy's cash value without incurring any surrender charges. Answer: B. Examine the policy for a specific number of days and return it for a full refund of premiums if not satisfied. The free look provision, also known as the 10-day right to examine, though the period can vary by state, often 10 or 20 days, allows a policy owner to review their newly purchased life insurance policy. If, for any reason, they are not satisfied with the policy during this period, they can return it to the insurer and receive a full refund of all premiums paid. This provision is designed to protect consumers by ensuring they have time to understand and accept the policy terms without obligation. Think of it as a trial period for your insurance policy. Question 17. An agent convinces a policyholder to lapse their current whole life policy and purchase a new one with the same insurer, primarily to generate a new first-year commission. This unethical practice is known as A. Rebating, B. Defamation, C. Twisting, D. Churning. Answer: D. Churning. Churning is an unethical and illegal practice where an agent encourages a policy owner to replace an existing policy with a new one from the same insurer, primarily to generate new commissions without a legitimate benefit to the policy owner. This differs from twisting, where the replacement policy is with a different insurer. Both practices are detrimental to the policyholder, often resulting in new surrender charges, higher premiums for the same coverage, and new contestability periods. Remember, churning is turning over policies with the same company for commission. Question 18. If a life insurance policy names the insured's children, per stirpes, as beneficiaries, and one of the insured's 3 children dies before the insured, leaving 2 grandchildren, how will the death benefit be distributed? A. The 2 surviving children will each receive 1/2 of the death benefit. B. The 2 surviving children will each receive 1/3, and the 2 grandchildren will share the remaining 1/3 equally. C. The death benefit will be divided equally among the 2 surviving children and the 2 grandchildren. D. The 2 surviving children will each receive 1/3, and the grandchildren will receive nothing. Answer: B. The 2 surviving children will each receive 1/3, and the 2 grandchildren will share the remaining 1/3 equally. Naming beneficiaries, per stirpes, Latin for, by roots, or, by branches, means that if a named beneficiary predeceases the insured, that beneficiary's share of the death benefit will pass down to their lineal descendants. In this scenario, the 2 surviving children each receive their 1/3 share. The 3rd child's 1/3 share, which they would have received had they lived, will then be divided equally between their 2 children, the insured's grandchildren, meaning each grandchild gets 1/6 of the total death benefit. This method ensures that the family lineage receives the benefit. Question 19. Under the Health Insurance Portability and Accountability Act, HIPAA, what is a key requirement for health plans regarding individually identifiable health information? A. They must obtain written authorization from patients for all uses and disclosures of protected health information. B. They are required to share patient information with employers to assess employee health risks. C. They must protect the privacy and security of protected health information. D. They are exempt from sharing patient data if a patient's employer requests it for underwriting purposes. Answer: C. They must protect the privacy and security of protected health information. HIPAA, the Health Insurance Portability and Accountability Act, establishes national standards for the protection of individually identifiable health information, known as Protected Health Information, PHI. A core requirement of HIPAA is that health plans and healthcare providers must implement safeguards to protect the privacy and security of this information. While certain uses and disclosures may require authorization, the overarching principle is the obligation to protect patient data from unauthorized access or disclosure. This regulation is crucial for maintaining patient trust and confidentiality in the healthcare system. Question 20. When an annuity is surrendered during its accumulation phase, the annuitant may be subject to a surrender charge. This charge is designed to A. Recoup the commissions paid to the agent who sold the annuity. B. Discourage early withdrawals and help the insurer recover initial expenses. C. Penalize the annuitant for not completing the full contractual term. D. Fund the annuitant's future income payments during the annuitization phase. Answer: B. Discourage early withdrawals and help the insurer recover initial expenses. A surrender charge is a fee applied when an annuity is surrendered or partially withdrawn during the accumulation phase, especially within the first few years after purchase. These charges are primarily designed to discourage early withdrawals, allowing the insurer to recoup initial expenses like agent commissions and administrative costs associated with issuing the annuity. The charge typically declines over a period, e.g., 7 to 10 years, and aims to ensure the insurer can realize a return on its investment in the policy. Remember that surrender charges are a common feature in many long-term financial products, not just annuities. Question 21. An insurance producer who collects premiums from an insured and then fails to remit them to the insurer is violating which fundamental duty? A. Duty of confidentiality. B. Duty of disclosure. C. Fiduciary duty. D. Duty of good faith. Answer: C. Fiduciary duty. An insurance producer, agent, holds a fiduciary duty to both the insurer and the insured. This means they are in a position of trust and confidence, especially when handling money. Collecting premiums from an insured and failing to remit them to the insurer is a direct violation of this fiduciary duty, as it involves mishandling funds that belong to another party. This breach of trust can lead to severe penalties, including license revocation, as the producer is expected to act in the best financial interest of those they represent. Always remember that handling money for clients comes with significant responsibility. Question 22. The guaranteed insurability rider in a life insurance policy allows the insured to: A. Purchase additional insurance coverage at specified future dates without proving insurability. B. Exchange their current policy for a different type of policy without a medical exam. C. Automatically increase their policy's death benefit annually to offset inflation. D. Continue coverage even if they become totally disabled and cannot pay premiums. Answer: A. Purchase additional insurance coverage at specified future dates without proving insurability. The guaranteed insurability rider is a valuable option that allows the policy owner to purchase additional amounts of life insurance at predetermined future dates, e.g., at specific ages like 25, 30, 35, or upon life events like marriage or birth of a child, without having to undergo a new medical exam or provide evidence of insurability. This is particularly beneficial for younger individuals who anticipate needing more coverage as their responsibilities grow but might develop health issues later in life. This rider guarantees your right to buy more coverage, regardless of your health. Question 23. An individual who receives a lower premium rate on their life insurance policy due to excellent health, a favorable family history, and a safe occupation is classified as A. Standard risk. B. Substandard risk. C. Preferred risk. D. Declined risk. Answer: C. Preferred risk. In underwriting, applicants are categorized based on their risk profile. A preferred risk classification is assigned to individuals who pose a lower than average risk to the insurer because they demonstrate excellent health, a very clean family history, a non-hazardous occupation, and a healthy lifestyle. This favorable classification often translates into the lowest available premium rates for their age and coverage amount. Understanding these classifications helps explain why premiums vary so much among individuals. Question 24. The entire contract provision in a life insurance policy states that the policy document, along with what other document, constitutes the entire agreement between the applicant and the insurer. A. The insurer's internal underwriting guidelines. B. Any prior verbal agreements with the agent. C. The attached application. D. The insurer's marketing brochures. Answer: C. the attached application. The entire contract provision is a fundamental clause in a life insurance policy, stating that the policy itself and the attached copy of the original application constitute the complete and sole agreement between the policy owner and the insurer. This provision ensures that no external documents, oral agreements, or separate rules can be used to alter or contradict the terms of the policy. It is crucial because it protects both parties by clearly defining the agreed-upon terms and preventing future disputes over what was or was not included in the contract. Question 25. Which of the following losses would typically be covered by an accidental death and dismemberment, AD&D, policy's capital sum benefit? A. Loss of income due to illness. B. Loss of sight in one eye. C. Medical expenses from a slip and fall. D. Death from natural causes. Answer: B. Loss of sight in one eye. Accidental death and dismemberment, AD&D, policies specifically cover losses resulting directly from an accident, not illness or natural causes. The capital sum portion typically pays a percentage of the policy's principal sum for specific dismemberment losses, such as the loss of a limb, hearing, or sight. For example, losing sight in one eye due to an accident would qualify for a capital sum payout, while death from natural causes would not, and medical expenses from an accident are usually covered by a medical expense policy. AD&D policies are designed for very specific, severe accidental injuries or death.